What is the secret of the top 1% that most people aren't talking about? Stay tuned on today's Fetta Facts while I share with you exactly what that is. Hey, welcome back to Fetta Facts. I'm Jerry Fetta, the CEO of Philanthro Wealth. If you didn't hear, my company Wealth Dynamics, I've owned it for many years, merged with a company called Philanthro Investors. Now, just like when you get married, you take each other's last name. In this one, we decided we were going to take each other's first name. So we have Philanthro Investors, the first part of that Philanthro. We have Wealth Dynamics, the first part of that being Wealth. So we have Philanthro Wealth as the company that I'm now running, the CEO of. And on that basis, what that means is we're focusing on building a network of wealthy philanthropists who not only create wealth in their own lives, but they also use their wealth to restore life essentials and promote human welfare. And we do this worldwide, okay? Now, today in Fetta Facts, something I've been doing for years, I'm not changing Fetta Facts, that's gonna stay. We talk about all facts, no opinions, right? And so as the CEO of Philanthro Wealth, one of the things I really wanted to cover today is I wanna talk about the reality of where wealth is built. Okay, not where the gurus say wealth is built. When we look at statistically, what are the top 1% of wealth actually doing? Right? And we could agree that that's what we want to know. We don't want to know what does someone tell us to do, whether that be a guru, whether that be Wall Street, whether that be a bank or a financial institution. We want to look at what did the historically wealthy actually do and what do we do to mimic that? What does the actual number and data show us, right? Now, here's the thing. We hear a lot about where to build wealth. You can go online, you can go on YouTube, you can go on TikTok, you can find any myriad of different ideas, strategies, concepts that you could utilize to build wealth. Okay, and I want to share with you today, based on real data, where do the top 1% actually build wealth? Not where do we say they build wealth, not what do we think is convenient to believe or any of that stuff. Where do they actually build wealth? And to do that, I'm going to be sharing a very important graph with you. Next, I don't want to interrupt you too long. I just want to give you a free offer for my book, The Blueprint to Financial Freedom. If you go to jerryfetta.com/B2F promo, you can get the book now. I'm going to let you get back to the video. Here we go. This is a graph called Ownership Society. This is from New York University. It's featured on wallstreetjournal.com. This graph, for me, was very telling. The first time I saw this, it was a couple of years back, and it really changed my perspective on where to focus my efforts as far as investing and acquiring assets, okay? So this is a graph called Ownership Society. If you read the description, percentage of total assets and liabilities held by the wealthiest 1%. That's the first part of this. So percentage of total assets. If we look at the total assets and liabilities, and we look at in each category, what percentage of those assets or liabilities are held by the top 1%. Okay, so the top 1% is green, okay, the green category here. Now, the other part of this is looking at, okay, what about the other echelons of wealth? Okay, so we have the top 1%. We then have the next 9%, right? So that's the top 10 to the top 1. Everything between 10 and 1, that's the next 9%. Then we have the bottom 90%. We have everyone else in America. Okay, now, one of the things I want to share with you is to be in the top 1%, typically speaking for the United States, that's about a $10 million net worth or higher, right? If you look at the top 1%, and we can check that really quick. And here's what I want to do is just fact check my numbers on what those thresholds are really quick. Right, so let's go on Google and let's just find out really quickly. What is the minimum required net worth in the US? What is the minimum required net worth in the US to be in the top 10% of wealth? Minimum net worth of 1.94 million, according to Motley Fool. This was as of July of 2024. Okay, so 1.994 million. So you basically need a $2 million net worth or higher. You're now in the top 10% of wealth in the United States. Now let's shave a zero off of that figure. What does it need to be to be in the top 1%? In the US, it will take you 5.81 million to be in the top 1%. However, among that, you've got like the ultra wealthy. But here's another one, Investopedia, minimum net worth of 13.87 million. We've got Visual Capitalist, So top 1% in the US, they also say 5.8. So somewhere between 5.8 and 14. And that's why I say, let's say it's about 10 million minimum to be in that category of top 1%. So it's between 5 and 10, depending on where you look. But if we go back to our graph here, that gives us a little more perspective of what it means to be in one of these different categories. And it gives us a little more perspective on what it means to observe based on where we want to be versus where we are or where our peers are, if that makes sense, right? So to be in the top 1% category, we already know that to do this, we need to be in the $5 to $10 million range, right? Because if you take into, 5.8 up to 14, right? 5.8, we might as well call that 6. 6 and 14 is 20. We divide that by 2, that's about 10. On average, it's about 10 million to be in the top 1%. To be in the next 9%, we need net worth of around 2 million. Okay, so what is bottom 90%? Bottom 90% is anything less than $2 million. Right? Those are our different wealth echelons. So when we talk about the top 1%, who has heard, invest in real estate? Okay. So I'm not saying you shouldn't, and I'm not telling you anything about my opinion. Let's just look at where do the top 1% actually invest? Okay. On non-home real estate, so it's not a primary residence, 34% is where they focus their efforts. Okay. 34% of non-home real estate is owned by the top 1%. So they're not even the biggest owner of non-home real estate. Okay. Who is the top 10%? With 44% of it, right? The bottom 90% is actually pretty close to the top 1%. There's only a 12% difference there, right? So when I look at this, what do I see? I see that real estate is an excellent way to get out of the bottom 90% into the top 10%. That's what this data tells me. It tells me that that's the place I want to start, right? Now, the other thing you can see here is if we do look at regular real estate, principal residence, right? Primary residence. 10% of primary residence assets, only 10% are owned by the top 1%. Okay, so you look at, where are they storing their net worth? It's really not in their home. It's not. They own so much other, and I'm not saying they don't have homes. Some of them do, some of them don't, but they're holding on like the total equity or asset value in the cap of primary residence equity is very small. Okay, you look at the next 9%. 31% of primary residences are owned by the top 9% there. 59% of primary residence equity value is owned by the bottom 90%. So when you hear me say, I'm not buying a home, I'm showing you why. Why? Because I'm copying the top 1%. I'm not emulating to be in the bottom 90. I'm not emulating to be in the top 10. I want to be in the top 1. So when I look at percentage of net worth, percentage of assets, I'm like, okay, good. So only about 10% of my net worth should be in my primary residence. Now, this statement is not about net worth. It's saying what percentage of the total assets, but I translate that over to my own financial balance sheet. And I say, okay, good. I don't want more than 10% of my net worth in a house. So that doesn't mean never own a house. It just means when it represents only 10% of what I own, then I'll do it. Okay. What's interesting here is the bottom 90, they own or they're indebted to 74% of all debt. The bottom 90% has almost 3/4 of all debt, mortgage, credit cards, car loans, you name it. The top 10% is indebted by 21% of all debt. The top 1% is indebted only by 5%. So I want you to see how low they are on their principal residence, how low they are on their debt. You can also see they don't have very much of the market on pension accounts. They don't have very much of the market on deposits. Okay. You can see that they do have quite a bit on life insurance. They have almost as much life insurance as real estate. Right now, you can see who's the main owners of life insurance. We've got the top 10%. We've got the bottom 90. Okay. You will never hear someone say, I became a top 1%er because of life insurance. That's going to sound funny to you because I'm all about the sacred account. But guys, I'm honest with this. I'm real. The sacred account is my banking system. Yes, I'm going to run everything through it, but it's the smart decisions that I use it for that build the real wealth. Running it through my banking system is just a smart idea. And I'm not leaving the assets there either, right? I'm borrowing against it and I'm deploying those elsewhere. So let's talk about where else they're deploying it. Okay. The top 1% own 50% of all trusts. They own 50% of all stocks and mutual funds. They own 55% of all financial securities, which are, investments with Wall Street, public and private markets. What is the number one asset of the top 1%? Business equity. Business equity. It's not real estate. It's not stocks, it's business equity. Now, there's a couple of different ways to have business equity, right? So you can be an entrepreneur, and most of them aren't. You're not going to see every single top 1%er that's like, I'm an entrepreneur, I came up with this, and I did this all by myself. Some do, some don't. So you can be an entrepreneur, you can bootstrap it yourself, or you can be a private investor. Hey, what's up? Jerry here. I just wanted to give you another reminder. Grab my book, Blueprint to Financial Freedom. It's going to be one of the best books you have ever read on finance. I can promise you that. You're going to love it. It's also a free offer. So if you go to jerryfetta.com/B2F promo, you can get that now. We're all familiar with the cash flow quadrant. You can be employee, you can be self-employed, you can be a business owner, you can be an investor. So you've got the top 1% bracket that decides I'm going to be a business owner. You don't get top 1% business equity by being self-employed, right? So you have people that are like, I'm going to be a business owner. So I'm going to run the company, own the company. Okay. You have some top 1%ers that say, I'm going to do this as an employee, right? Because as an employee of a company that's got top 1% potential, if you're a C-suite executive, if you're a vice president, you're somewhere in that echelon, you get equity. You get equity in the company. If the company does really well, you experience that. Okay. You can also do it as an investor. An investor typically means that I'm an accredited investor. I built $1 million net worth or higher. Okay. You can get there by income. Income is not my favorite. It never has been because you have to pay taxes on that income. And you also, high income doesn't necessarily mean high liquidity. So I'm going to give you an example of this. I just got off a phone call today with, another CEO. And they're about to complete a public merger. Like they're merging with a publicly traded company. And so as the CEO of Philanthro Wealth, I'm helping with this merger. I'm helping them, get this thing rolling, get the awareness levels of the company up with the public, finding people who are maybe interested in learning more about getting in with them as an investor. It's not an offer to you at all, but I'm just saying that's what I was doing on this call. And on this call, it was very interesting because a pre-initial public offering stock, it's called pre-IPO of a company that has revenue, that has earnings, that has profitability. They're now merging with another company that's already public. That's going to make them public. And if you're able to invest in something like this pre-IPO, once the IPO happens, the stock does go public, you basically got in before everybody else. So if it does well, I want you to imagine what happens. Now the entire public market is interested in this new stock, this new venture. The traders pick it up, the investment bankers pick it up. All this stuff starts occurring. You were one of the first ones in. Right? So one of the ways wealth is built is on pre-IPO companies. This is business equity. You're buying equity in a company. Okay, now as an investor buying equity in a company, you don't need to be an employee. You don't need to be the business owner. Okay, I've run several businesses and I'm telling you that if you're just looking for financial return, net worth growth, being part of something you believe in and want to support, you don't necessarily want to be the one responsible for running it. You don't necessarily want to be the one that has to organize and make the company move. It's funner for the average everyday person that's accredited to say, I want to participate in the upside, in the equity, in the story, the growth, maybe not the management or the ownership of the majority of it where I actually have a job now, or I have a business I've got to pay attention to. Okay. I want to relate it to this. It's a little bit like if you're a grandparent, having the grandkids over for the weekend and then sending them back home. Done. They go back home. Your life continues versus having children. Starting a business is like having children. Okay. Now, In that sense, that means that you have a huge responsibility. Being an investor in a private company is more like having the grandkids over for the weekend. You get all of the upsides. Do you have some downsides? Sure, but not quite as many. It's like, they didn't sleep last night. They're cranky today. I'm going to send them back to mom tomorrow. Right? So when I study this chart here, what I'm sharing with you is, for me, I'm in the top 10%. Right? I'm not in the 1% yet. Probably for my age I am, but overall, not in the 1% yet. I'm in the top 10%. So I need to be doing my investing the way that the people are doing it in the category I would like to be in. Not the way that my current category does them or the way that the category below me does them. So let's share the chart again, and I want to review it from that perspective. So if I am in the bottom 90, I have a less than $2 million net worth. I should not be loading up on debt. I should not be getting a primary residence. Okay. Most of this 35% of life insurance is actually the wrong kind of life insurance. I should not be buying a bunch of term insurance or indexed universal life insurance. That's not where the 1% are at. Okay, I shouldn't be putting a bulk of my money in deposits. I need to be looking at, okay, what are the metrics of the people I want to be like? Okay, so if I want to be like someone, I need to look at what are they doing. So instead of the primary residence, I should be focused more on my pension accounts. There are some deposits. I should be heavily focused on life insurance. I should be heavily focused on real estate. There's a little bit of trusts, mutual funds, stocks, securities, business equity going on. But the majority of this is what? Putting money in my pension accounts. I'm not a huge fan of that one because it defers your lifestyle, right? But for sure, you've got deposit accounts, you've got life insurance, you've got real estate, okay? You even got financial securities. That's where I would consider gold. Okay, so that's where I'm going. I'm focusing on those things in the bottom 90. Now, if I'm already in the top 10, I've already got a $2 million net worth, and I'm looking at how do I become a top 1%er? Where am I focused? I need to continue doing life insurance. I need to continue doing real estate, but I need to start looking at this business equity stuff. I need to start looking at the securities. And when I talk about securities, I'm not a fan of the public markets. I think that's the soup of the day or the special at the restaurants, the leftovers nobody else wanted. When I can get in as a venture capitalist, an angel investor, a private equity investor, right? Those are the things I'm looking at as far as business equity and securities are concerned. Okay, so I'm starting to get into that world more because that's the group I want to be in. I made it to the top 10%. Now, I'll tell you what, guys, growing up in Big Lake, Alaska, I never thought I would make it in the top 10%, let alone be looking at, okay, now I'm going to crack it into the top 1. Right? So this is, guys, all facts, no opinions. That's the data. That's the data. So if you're in the bottom, you should be focused on real estate. You should be focused on your life insurance. Okay. If you're in the middle, you need to keep doing the real estate and keep doing the life insurance and get up to that $2 million net worth or higher. Then you start focusing on private equity, venture capitalism, angel investing, getting that business equity so that you can become a top 1%er as well. That's all I got for you today. Thanks for watching on today's Fetta Facts. Like, share, subscribe, comment below if you have any questions, and I'll see you next time. Hey, this is Jerry Fetta here. I want to thank you for watching my video, watching my content. I hope you enjoyed it. If you would like to learn more about the blueprint to financial freedom and how you can achieve passive income that exceeds your savings, your expenses, your taxes, your generosity, and build wealth like the top 1%, I want to encourage you, grab a copy of my book, The Blueprint to Financial Freedom. You can go to jerryfetta.com/B2F promo, or you can click the link in the description of the video here. The copy is free. You cover your shipping. We'll send the book out to you, and we'll send you an email with a bunch of great bonus material also for free. Get the book, subscribe to the channel. I'll see you on my next content.